Every time the economy blows up, people act shocked. They say, no one could have seen this coming. This is different. This is unprecedented. And yet, if you look past the noise, financial crises repeat like a bad habit. The faces change, the technology changes, the excuses change, but the psychology, the fear, greed, denial, panic, stays exactly the same. You don't need a PhD to notice it. You just need to live through a couple of cycles. Economist Hyman Minsky had a line that cuts straight to the bone. Stability is destabilizing. At first, it sounds like one of those intellectual quotes people pretend to understand, but it's actually the simplest truth about money. When things feel safe, people relax. And when they relax, they get reckless. They borrow more, they spend more, they take stupid risks dressed up as strategic decisions. And that's when a crisis quietly starts forming. Not during chaos, but during comfort. If you want to understand why every financial disaster looks identical, don't look at charts or indicators. Look at human beings. Start with the ordinary worker, the guy who wakes up early, takes the same bus every morning, and tries to follow the rules life gave him. When the economy is booming, he feels it in little ways. Groceries feel cheaper, the paycheck stretches further, the boss isn't breathing down his neck as much. Maybe he even gets approved for a loan he never thought he'd qualify for. It feels like life is finally cooperating. But then reality shifts. Prices start creeping up so slowly he barely notices. Rent jumps, gas costs more, utilities climb, and his salary? Stagnant. He walks out of the supermarket with the same groceries he's bought for years, except now it costs 30% more. He doesn't call it inflation, he just feels robbed. By the time the crisis hits the headlines, he's already living inside it. When layoffs begin, he's the first on the chopping block. Not because he did something wrong, but because in every downturn, the system protects capital, not people. He loses a job, savings vanish, debts tighten like a rope around the neck, and suddenly, he's one unlucky break away from disaster. For him, a crisis isn't a macroeconomic event. It's personal. It's brutal. It's survival. Now look at the business owner. When the economy is good, he feels unstoppable. Customers spend without thinking. Revenue climbs. Loans are approved instantly. Banks throw money at him like they're allergic to it. So he grows, expands operations, hires aggressively, signs new contracts, maybe even upgrades to a bigger office he doesn't technically need, but feels he deserves. Business feels like a rising tide, and he thinks he's the one pulling the ocean. But then the tide goes out. Suddenly there's silence. Fewer clients, smaller orders, delayed payments, and his nice, comfortable cash flow dries up. Meanwhile, the bills are still coming. Rent, payroll, inventory, taxes. He lies awake at 3 a.m. thinking about the people who depend on him. Employees with families, loyal customers, suppliers. He feels like he's responsible for half the planet, even though he's barely keeping the lights on. When a crisis hits a business owner, it attacks his identity. It makes him question whether he was ever competent or just riding the wave. It forces decisions he never imagined making. Firing people he likes, canceling plans he was proud of, downsizing the dream he spent years building. For him, a crisis doesn't just break the company. It breaks the illusion of control. And then we have the investor, the dramatic protagonist of every financial story. When markets rise, he transforms into a genius in his own mind. His portfolio goes green, and he convinces himself it's because of his intelligence, discipline, and deep understanding of market structure. Meanwhile, the truth is much simpler. He got lucky in a bull market. But luck is loud, wisdom is quiet, and people prefer the noise. John Kenneth Galbraith said it perfectly. In booming markets, intelligence becomes indistinguishable from luck. And investors believe it. They buy assets they barely understand, they take risks they'd never admit out loud, and they start thinking the rules don't apply to them. They read one newsletter, watch 2 YouTube videos, and suddenly they're financial prophets. Then the cycle turns. The same market that made them feel brilliant now exposes every weakness. At first they deny it. It'll bounce back. Then they get frustrated, then afraid, and finally, full-on panic. They start selling at the exact worst moment, locking in losses that will haunt them for years. A crisis peels off the mask. It shows whether they were truly skilled or just surfing a wave and calling it expertise. What's fascinating is that these 3 people, the worker, the business owner, the investor, all experience different lives, but when a crisis hits, their emotional trajectory is identical. It always starts with hope, turns into confidence, then slides into excitement, then arrogance, then denial, and finally collapses into fear, panic, and regret. After that comes recovery and the slow return of optimism, until everyone forgets again. History proves it every time. The Dutch in the 1600s thought tulips were the future. Americans in the 1920s thought stocks could only rise. The dot-com crowd believed websites didn't need profits. The 2008 generation believed housing prices were invincible. The crypto wave believed dog coins and pixel art were unstoppable. Different bubbles, same human nature. Philosophers predicted this long before economists. Nietzsche said, "What doesn't kill you makes you stronger." In finance, that usually means it kills your savings first. Keynes warned that markets can stay irrational longer than you can stay solvent. And Santayana made it painfully clear. Those who cannot remember the past are condemned to repeat it. And nothing describes financial markets better. So why, if we know all of this, do we keep repeating the same disaster every decade or two? Because people forget. Not instantly, slowly, quietly, the way rust spreads on metal. After a crisis ends and markets recover, the pain fades. The memories soften. The warnings feel less urgent. And that tiny sense of caution everyone had, it dissolves. The desire to get rich fast is stronger than any lesson history tries to teach. A worker who once feared losing his job eventually feels comfortable again. A business owner who swore he'd never take on so much debt again starts believing this time he's more prepared. An investor who cried during the last crash suddenly believes he's smarter now, that he understands the market, that he won't repeat the same mistakes. But he does. They all do. Because humans don't operate on logic. They operate on emotion, memory, and ego. And ego has the shortest lifespan. All it takes is a few years of rising prices, a few headlines about economic optimism, a few success stories from people who took big risks, and suddenly the entire world convinces itself that the rules have changed, that this boom is special, that this technology is revolutionary, that this market cycle is blessed by destiny. And then the pattern begins again. You can see this pattern across centuries. In the 1800s, people were so convinced railroads would change the world that they invested money into rail lines that didn't even exist on a map. Investors threw fortunes at companies that were nothing more than newspaper ads and a dream. When the bubble burst, entire banks collapsed, and cities went bankrupt for decades. In 1929, Americans borrowed money just to buy stocks, because the idea of a falling market felt impossible. When the crash finally came, suicides rose, savings evaporated, and an entire generation learned a brutal lesson. Markets don't care about your optimism, your plans, or how certain everything looked yesterday. Japan in the 1980s created the most absurd real estate bubble in history. People bought land not because it had value, but because everyone else wanted it. At the peak, the land under the Imperial Palace was valued higher than all the land in California. Think about that level of delusion. And then it collapsed. Not just for a year or two, but for decades. Japan's markets still haven't fully recovered 35 years later. The dot-com bubble was the same story with shinier toys. People bought companies with no revenue, no product, no business model. If it had a website and a cool-sounding name, investors acted like it was the next revolution. Then 2008 arrived and exposed the biggest lie of all, that debt could grow forever, that banks could engineer risk out of existence, and that houses were guaranteed to rise in value. People with no income bought luxury homes, banks packaged garbage loans into safe investments, and investors convinced themselves the whole thing made sense. Until it didn't. And then crypto had its turn. Meme tokens, cartoon JPEGs, coins named after dogs. People threw money into anything that moved. They convinced themselves they were early pioneers in a digital revolution. Some were. Most weren't. The cycle doesn't care about intentions. It just keeps running. That's the brutal truth of financial history. Bubbles aren't born from stupidity. They're born from optimism. And optimism, left unchecked, becomes dangerous. But here's the twist. Crises aren't just destructive. They're cleansing. They burn away the weak, the hollow, the fake, the over-leveraged, the unprepared. They expose companies built on hype, investors built on ego, and economies built on sand. What survives becomes stronger, because it has to. After every crisis, the worker becomes less naive. He starts paying attention to prices, to savings, to stability. He becomes more intentional about where his money goes, because he's seen how quickly life can turn. The business owner becomes more disciplined. He trims the fat, eliminates the waste, and stops believing that growth is guaranteed. He starts running his business with seriousness instead of adrenaline, because he knows the storm will come again, and next time, he wants to be ready. The investor becomes more humble. He stops chasing every shiny trend. He learns the difference between speculation and investment. He realizes that surviving is more important than being right. And he finally understands what every great investor learned the hard way. Wealth isn't built by being smart. It's built by avoiding stupid decisions. And then, just when everyone becomes wiser, calmer, more rational, another boom arrives. Slowly, quietly. Markets rise. Optimism returns. People start taking more risk. Borrowing increases. Spending increases. Assets inflate. Stories spread about how someone made millions. Someone bought a house that doubled in price. Someone invested in a startup that exploded. People watch and think, why not me? And the cycle resets like a clock. This is why George Santayana's quote hits so hard. Those who cannot remember the past are condemned to repeat it. Except in finance, people can remember. They just choose not to. Because repetition is profitable on the way up. Forgetting is comfortable. And risk feels invisible until the moment it detonates. Financial crises aren't errors in the system. They are the system. They're the reset button built into human psychology. A reminder that greed needs consequences, that optimism needs limits, and that markets don't reward people simply because they want to believe a story. Every crisis looks identical because every generation believes they're smarter than the last. And every generation learns the same painful lesson. The market doesn't care how confident you are. It cares about reality. If you want more brutally honest breakdowns like this, hit that like button so this video gets pushed to more people. And subscribe to AINABEKOV channel, the only place where we break down the madness of financial history with zero fluff, zero fear, and zero bullshit. Stay sharp, more deep dives are coming. History proves it every time. The Dutch in the 1600s thought tulips were the future. Americans in the 1920s thought stocks could only rise. The dot-com crowd believed websites didn't need profits. The 2008 generation believed housing prices were invincible. The crypto wave believed dog coins and pixel art were unstoppable. Different bubbles, same human nature. Philosophers predicted this long before economists. Nietzsche said, "What doesn't kill you makes you stronger." In finance, that usually means it kills your savings first. Keynes warned that markets can stay irrational longer than you can stay solvent. And Santayana made it painfully clear. Those who cannot remember the past are condemned to repeat it. And nothing describes financial markets better.